You own a Taco Bell. It is 11:30 at night. Cars are wrapped around the drive-thru. Delivery orders keep appearing on the screen. The kitchen is moving non-stop, and by the end of the year, millions of dollars could have passed through your registers. Sounds like a great business. But here is the problem. Almost none of that revenue starts as your money. Before you pay yourself, Taco Bell gets paid. Your employees get paid. Your food suppliers get paid. The landlord or the bank gets paid. Utilities, insurance, equipment, maintenance, technology, taxes, they all get paid. And before you even get the chance to discover whether the restaurant makes money, Taco Bell currently wants prospective franchisees to demonstrate roughly $5 million in personal net worth and $2 million in liquidity. So why would a restaurant selling tacos, burritos, and $7 combo meals require an owner who's already a multimillionaire? And if one Taco Bell can generate millions in sales, how much of that money actually belongs to you? When you buy a Taco Bell franchise, you are not buying Taco Bell. You are buying permission to operate inside Taco Bell's system. That distinction matters. Taco Bell supplies something extremely valuable: recognition. The customer already understands the menu. They already know the logo. National advertising is already creating demand. Recipes, restaurant layouts, equipment standards, suppliers, technology, and operating procedures have already been developed. You are skipping one of the hardest stages of starting a restaurant, convincing people that your restaurant exists. But that shortcut is not free. The franchisee brings the capital, takes on the local operating risk, hires the employees, and runs the restaurant. The franchisor provides the brand and the system. Then both sides take a piece of the economics. And Taco Bell has become very good at this model. At the end of 2025, Yum! Brands reported 9,030 Taco Bell restaurants worldwide. Roughly 93% were franchised. That tells you something important. Taco Bell is not simply in the taco business. It is also in the business of building a system other people are willing to invest millions of dollars to operate. Now imagine you want in. Before discussing your favorite location or how many crunch wraps you think you can sell, there is a financial test. Taco Bell's current franchise website lists approximately $5 million in personal net worth and $2 million in personal liquidity. Liquidity matters because a $5 million net worth does not necessarily mean you have $5 million sitting in a checking account. Your wealth could be tied up in property, businesses, or investments. Taco Bell wants substantial accessible capital. Why? Because opening the restaurant is only the beginning. Construction can run over budget. Permits can be delayed. Equipment breaks. Sales can disappoint. Labor costs move. Food prices change. And debt still has to be serviced. A thinly capitalized owner can turn a temporary problem into a permanent failure. So Taco Bell is effectively saying, if something goes wrong, you need enough financial strength to survive it. And plenty can go wrong before your first taco is sold. Current estimates, based on Taco Bell's franchise disclosure materials, put the initial investment for different traditional restaurant configurations at roughly $935,000 on the low end to more than $4.3 million on the high end. That spread is enormous because not every restaurant is the same. Real estate varies. Construction varies. The format varies. The market varies. A major portion can disappear into land or lease costs, site preparation, and construction. Then comes the kitchen, cooking equipment, refrigeration, drive-through systems, point-of-sale technology, furniture, signage, decor, permits, opening inventory, training, and working capital. The franchise fee itself can reach about $45,000, but compared with building the entire restaurant, that may be one of the smaller checks you write. And then opening day arrives. Now, the expensive part begins. Operating it. Taco Bell's scale is enormous. Yum! Reported approximately $18.4 billion in worldwide Taco Bell system sales for 2025. But system sales are not Taco Bell corporate revenue, and they are definitely not franchisee profit. They represent sales occurring across the restaurant system. This distinction is everything, because revenue looks impressive until you start following the money. Let's make the math simple. Imagine your restaurant generates exactly $2 million in annual sales. That is about $5,480 every day if averaged across the full year. Now watch what happens to those $2 million. According to current franchise information, Taco Bell's continuing royalty is approximately 5.5% of gross sales. The national advertising contribution is approximately another 4.25%. Combined, 9.75%. On $2 million of sales, that equals approximately $195,000. And notice the important word, sales, not profit. If your restaurant has a fantastic month, those percentage-based fees apply. If labor costs explode and your profit disappears, those fees still apply to the sales you generated. Think about every $100 that enters your restaurant. Roughly $5.50 goes to the royalty. Another $4.25 goes toward national advertising. You now have about $90.25 remaining, and we have not purchased the food yet. We have not paid a single employee. We have not paid for the building. This is where the headline revenue starts shrinking quickly. Every taco has an ingredient cost: beef, chicken, beans, cheese, tortillas, sauces, produce, packaging, cups, napkins, even the sauce packets somebody takes 20 of. Individually, these costs can look tiny. Across hundreds of thousands of orders, they become enormous. Then add waste. Overportion an ingredient by a small amount on thousands of orders, and the difference becomes real money. Prepare too much food and throw it away? That is money. Inventory disappears? Money. Ingredient prices increase? Money. A restaurant with strong sales can still suffer if it cannot control what every order costs to produce. Then comes labor. Crew members, shift leaders, managers, training, payroll taxes, benefits where applicable, overtime, and scheduling. Labor is interesting because customers experience it as service. The owner experiences it as economics. Too few workers and orders slow down. The drive-through line grows. Customers leave. Accuracy falls. Too many workers, and you're paying people faster than the restaurant is generating demand. So the objective is not simply cutting labor. It is matching labor to transactions. This is one reason drive-through speed matters so much. If the restaurant can serve more customers during the same expensive hour, fixed costs are being spread across more transactions. 30 seconds saved repeatedly can eventually turn into thousands of additional orders. Now, look around the restaurant. Almost everything you see costs money twice. First to install, then to keep working. HVAC, refrigerators, fryers, grills, point-of-sale systems, digital menu boards, drive-through equipment, plumbing, electrical systems, parking lots, roofing. The building does not care whether Tuesday was slow. Rent continues. Or, if you finance the property and construction, debt payments continue. Then there are utilities, insurance, maintenance, cleaning, technology, and future renovations. This is why sales volume matters so much. Many costs do not shrink simply because fewer customers appear. Imagine two Taco Bells. Same logo, same menu, similar building. Store A has a fantastic location. Heavy traffic, fast drive-through, strong late-night demand. Its fixed expenses are distributed across a huge number of orders. Store B is only a few miles away. But access is inconvenient. Traffic is weaker. Labor scheduling is inefficient. Equipment problems slow the kitchen. Both restaurants pay percentage-based franchise fees. Both need managers. Both need equipment. Both have occupancy costs. But Store A has far more revenue available to absorb those expenses. This is operating leverage. Once enough of the fixed cost base is covered, additional profitable transactions can become significantly more valuable. But operating leverage works in reverse too. When sales fall, the landlord does not automatically lower the rent. The refrigerator does not become cheaper. Your debt does not politely wait for customers to return. There is an interesting clue inside Yum's own numbers. In 2025, Taco Bell's company-operated restaurants reported a restaurant-level margin of approximately 24%. In the second quarter of 2026, Taco Bell reported a U.S. company-owned restaurant margin of 26.2%. That does not mean a franchise owner personally pockets 26 cents from every dollar. These are company restaurant-level accounting margins. A franchisee has a different cost structure, including franchise fees, financing, taxes, overhead, and capital requirements. But it demonstrates something important. A high-volume Taco Bell can be an extremely powerful operating machine. And recently, demand has remained strong. In the second quarter of 2026, Taco Bell reported U.S. same-store sales growth of 7% and U.S. system sales growth of 9%. The brand clearly knows how to generate customer traffic. The question for an owner is whether their particular restaurant can translate that demand into attractive returns on the millions of dollars invested. And that brings us back to Taco Bell wanting wealthy franchisees. The economics become more interesting when you stop thinking about one restaurant. Imagine owning 10. You can build management infrastructure across multiple stores. Experienced supervisors can oversee several locations. Administrative systems can be shared. Local market knowledge improves. One weak store does not necessarily define the entire portfolio. And once an organization knows how to open and operate Taco Bell successfully, building the next location becomes a repeatable process. This is why the real business may not be own a Taco Bell. It may be build a Taco Bell operating company. One restaurant is a business. 20 restaurants start looking like a system. So let's return to our $2 million restaurant. On $2 million of sales, approximately $195,000 can disappear through the 5.5% royalty and 4.25% national advertising contribution alone. What happens to the remaining money depends heavily on the restaurant. Food control, labor efficiency, location, occupancy cost, maintenance, financing, management, transaction volume. A highly efficient restaurant with strong traffic can produce substantial restaurant-level cash flow. A weak location with high debt and inefficient labor can watch almost all of that cash flow disappear. And that is the strange part. Both stores can have the same Taco Bell sign outside. Customers may never see the difference. The difference appears on the owner's financial statements. So what are you really buying when you buy a Taco Bell? Not tacos, not burritos, not even the building. You are buying access to a proven demand engine. Taco Bell gives you the brand, menu, marketing power, supply chain structure, and operating system. You provide the capital and execution. And the economics depend on what happens between those two things. The sticker price can exceed $4 million. The franchisor gets paid from sales. Employees get paid. Suppliers get paid. The property gets paid. The equipment gets paid. The bank gets paid. And eventually, whatever survives belongs to the owner. That is why a packed drive-thru can be misleading. It tells you the restaurant is busy. It does not tell you the restaurant is profitable. Because owning a Taco Bell is not really a bet on how many tacos Americans want to eat. It is a bet on location, volume, labor efficiency, and capital allocation. The tacos bring the customers. The system creates the revenue. But controlling what happens to every dollar after the sale, that is the business.